Good afternoon, everyone. We'll be commencing this webinar shortly. We are doing a live feed to social media. And we're just finalising that connection now. If you have any questions during the webinar, please type the question in the chat and I will answer the question during the webinar. The people watching the live feed on social media, if you have a question, you'll have to send me an email, So the address is peter@essbiztools.com.au. If you're watching this webinar at a later time more suitable for you, please send me an email, peter@essbiztools. So welcome to this webinar. I'm Peter Towers, founder and managing director of ESS BizTools. I hope you're having a wonderful day. There's a few myths getting around about crowdsourced funding, equity raising, so let's bust one of them very early in this presentation. And that is that a lot of people believe that the only type of entity that can apply for crowdsourced funding equity raising is a unlisted public company. That's a myth. It was true for about 7 or 8 months back in 2018, but then the government responded to some criticism from the financial industry and legislated for private companies to be included in the eligibility. So it's now the private companies and unlisted public companies who meet the similar requirements then of the legislation to enable the company to be able to raise capital direct from the public without issuing a prospectus. So the aim is to create the crowdsourced funding equity raising framework. That's what the legislation, the amendments to the Corporations Act were made for. So how's it all begin? How's this work? The public are able to invest in private companies in a growing number of countries around the world. This happened from around 2010. But it took until 2017 to the Australian government of the day, led by Malcolm Turnbull, decided to introduce legislation to assist small companies to be able to raise capital. What I can understand of Malcolm Turnbull's history is he had a lot of knowledge of the frustration that directors of small companies had in raising capital. And indeed, I understand from news reports that Mr. Turnbull was quite successful in some of his original investments. So he was keen to ensure that legislation was introduced during his term as Prime Minister to try to make the road a little bit easier for small business. One of the challenges I want to present to you today, are you happy that the road has been made easier? It's been made easier for some companies, but I think there's a lot more work to be done here. And I suspect that a lot of that work can actually be undertaken by accountants, but more about that later as we go through this presentation today. So the government reacted to the criticism and decided that private companies could raise capital, but the total amount of capital from any type of capital raising for both the unlisted companies and the private companies is $5 million in a 12-month period. What that means in actual practice is that the company can go back to the market after the expiration of 12 months. The legislation's a little bit unclear whether you could do that for 5 years. Someone asked me that recently. And I said, as far as I can see, you could continue to raise capital. But maybe if that happened, ASIC may be advising the government to make some amendments to the law. Australia was playing catch up when in 2018, when this legislation was introduced. And I think our main objective in playing the catch-up was New Zealand, because what had started to happen was that smart young Australian companies were going across the ditch, as it were, and starting their operations in New Zealand so that they could take advantage that the New Zealand government had introduced crowdsourced funding equity raising. But around the world, crowdsourced funding equity raising had started to take momentum in the Western world as such. UK, USA, Canada, France, Germany, Singapore, New Zealand, and other countries had embraced it before we got involved. We learned some of the lessons from those other countries, but I think we've still got a long way to go. When we look back what's occurred, despite the COVID crisis, which definitely put crowdsourced funding back, as it did a lot of other things in Australia, the capital raising has continued, but I think it could have done a lot better than what it has done. So let's look at the numbers. We're accountants. We're in the numbers game. $347 million has been raised direct from the public. 72% of that, a survey has indicated, came from retail investors, with the balance coming from sophisticated investors. And there's been 489 companies make this contribution. So even though capital up to $5 million can be raised, in actual fact, only about 4 or 5 companies have raised the full amount, and one of them raised it in 2 tranches. So the average raise is considerably less. In fact, the smallest raise I've heard about was about $50,000. Maybe that was the first step in an overall campaign. I don't know. But capital is being raised. Businesses are growing. Some of the companies that originally raised have come back 2 or 3 times since and raised further tranches of money, which they've then obviously spent in accordance with their business plan, and then they've gone back to the market and raised more money. So the system is working. So the legislation introduced new concepts into Australia. First of all, that companies could raise capital without producing a prospectus. So we're not doing a public company listing. We're not going through the whole disclosure process of a public company, although there's a lot of disclosure occurs in crowdsourced funding equity raising. The Australian Securities and Investment Commission were given power in the legislation to license persons or businesses that had financial services industry licenses to become crowdsourced funding intermediaries. So those persons that were interested had to apply. At the time, back in 2018, the media reported nearly 300 businesses or individuals that met that criteria submitted applications to ASIC for approval. The intermediaries have a dual responsibility. This is quite unique to this type of legislation. First of all, they are the representatives of ASIC in this whole process. They've got a lot of power. ASIC don't decide who's going to be admitted to crowdsourced funding equity raising. The appointed crowdsourced funding intermediary does. But they're also a broker. They're also there to help the company that they've approved to raise the capital that they've identified. So it's a very important role the crowdsourced funding intermediary has. And it's very important that if you're advising your clients, that they understand this dual responsibility. They do wear 2 hats in their dealings with the companies. So let's look at the qualification. Turnover internationally, less than $25 million in the previous 12 months. Gross value of assets worldwide, less than $25 million. Not listed on a stock exchange, either the applicant or any subsidiary. And what I should have said is those financial and turnover and assets applied to both the applicant company and any subsidiaries. Not listed on a stock exchange. They are not able to use the funds to invest in securities or managed schemes. The government wants the money invested into real business activities so that the investors can see the benefits. It's to create a new type of business. It's to expand their current business. It's not just to idly sit in an investment account somewhere. The government wants the money being utilised in the businesses to create employment, to create economic activity. And a private company that's wanting to become a crowdsourced funding company must have 2 directors by the time the application starts. So, as you know, private companies only need 1 director, but if they're going to apply to be a crowdsourced funding company, they need to have 2. They've already got 2. If they're a unlisted public company, in fact, I think the figure there is 3 directors that an unlisted public company need. So they already meet that criteria. Obviously, they can have more directors, and my recommendation would be that they do so. Now, who are these intermediaries? Unfortunately, ASIC do not publish a list of who the intermediaries are. So they've appointed quite a number of people to be an intermediary. What I can determine at present, the current businesses who are active as crowdsourced funding intermediaries are Birchall, who's based in Melbourne, Venture Crowd, On Market and Venture Capital, 3 Sydney organisations, and Swarmer in Adelaide. There could be additional businesses out there who are performing crowdsourced funding intermediary roles because they've got the licence, and we continually update our material. So since 2018, we've probably had 25 names of intermediaries listed from time to time in the updating material within ESS BizTools because the numbers change. The original concept from ASIC was to have 16 intermediaries. That's an important figure, which I'm going to come back to later in this presentation to you. So what's the intermediary's role? I've said they're very powerful. So let's go through and have a look at it. They're a representative of ASIC. So they have to satisfy themselves that the applicant company meets all of the legislation guidelines. And like anything to do with legislation, there's a fair bit in there. So that relates to who the company is, who the directors are, who the officers of the company are. So if you're advising someone in this regard and they've had a prior problem with ASIC, which recorded or involves some sort of record being noted about them, you need to warn the directors or the team member that that information is going to have to be published if they're a director or a management team member of the new company that's going to be trying to raise capital in this way. So they may have to consider their position if they don't want that information included in the documentation that's lodged. They're there to assist the company directors and management to understand the operations of crowdsourced funding, but they don't see their role as being the professional advisor like they would look at you as the accountant. And I think that's very important. I take the attitude that as the professional advisor, it's my responsibility to make sure that the directors and leadership team of a company that we're mentoring on going into crowdsourced funding, equity raising, understands the rules and in particular really understand the power, the duties and the responsibilities of the intermediary and the fact that they're also going to help them raise capital. So it's a mixture rule. There's a fee to be negotiated. The legislation doesn't set a fee. It doesn't all have to be in a payment amount as such. It could be an allocation of shares in the company that can be negotiated. But that negotiation needs to be finalised before the capital raising process commences because details of it must be disclosed in the documentation, which I'm coming to shortly. The intermediary has to review all of the documentation. So whilst I said at the beginning there's no prospectus, there is another document called the Crowdsourced Funding Offer Document, which does require a fair bit of information, a lot of information on the history of the company and of the history of the directors and the management team members. that I referred to just a little bit earlier has to be disclosed. Now, all of that information that is supplied is displayed on the viewing platform. It's the quaint words used in the legislation. And obviously it's the internet. It's on the website of the intermediary, that all of the information of a company that they have agreed can be admitted to this program has to be displayed there. And that's where the applications for shares have to be processed through. So a director can't go and talk to his favourite 90-year-old aunt who's insisting on investing $200 into this company. The aunt has to apply through the viewing platform because there is a very important document, the risk declaration that she has to sign, as all investors have to sign, that they've read and they've understood. Because the government is very concerned, or was very concerned in this legislation, to ensure that people understood that investing in private companies can be very risky. And they wanted them to acknowledge that they've been warned this. In other words, the government doesn't want people coming back and complaining that something went wrong with this particular company and they've lost their money. So members of the public are able, and anyone indeed the world, I was going to say Australia, but anyone in the world can click on to the intermediaries platform, their websites, and pick out a company. And some of these intermediaries, particularly Virtual, which I'm going to refer to in a moment, Virtual could have 3 or 4 companies raising capital at any one time, and as the other intermediaries could also. So you click onto the company you're interested in, and you can watch videos, you can watch information, you can watch interviews with the directors and the leadership team, and all of the documentation that's contained within the offer document has to be available there for people to read. If potential investors got a question, they can type in their question. That's going to the intermediary. The intermediary will then contact the directors, normally a nominee of the directors. It's said he or she will be available literally 24/7 for this process. And the intermediary will be anxious to get a reply back to that question, preferably within 24 hours, so it can be then uploaded onto the website so that other people who are looking to decide whether they're interested in investing in this particular company can see what the question was and then can see the reply. So this is a very open, transparent investment process, probably more open and transparent than investing on the stock exchange, because all of this information can be asked for by an investor and the company needs to supply it. The intermediary will be keen to make sure the directors comply to answer that, because if the question is not answered, it will remain there. The intermediary will not remove it. The question will remain there because the directors have to supply the answer to it. The intermediary is also the adjudicator on legal requirements as contained within the legislation. Now, a lot of this gets back to who the investor is, to make sure that there's details so that they can clearly identify whether the investor fits into the retail investor category or the sophisticated investor category. If the investor fits into the retail investor category, the intermediary will be taking special note because there are special cooling off processes available for retail investors. The intermediary also has to decide any disputes, and there can be disputes that arise, and the intermediary can in fact stall the capital raising process for a while, a week, 2 weeks, to enable the company to assemble some information if the intermediary believes that the market is not being fully informed This could have occurred because of a question that's been raised. Pardon me. So deciding any disputes is a very important role of the intermediary. And it's very important that you make sure that if you're advising a client to raise crowdsourced funding, that the directors and leadership team members really understand this is how the process works. The worst thing to happen is to have the director saying, oh, I'm not going to give them that. It will destroy this whole program because that question will remain there. And the intermediary may well decide to close the capital raising process because the market's not been fully informed. The intermediary has to keep a record of all applications, make sure everyone has signed the declaration that they understand the risks and they collect the money, which basically is sitting in trust at this stage. The intermediary decides when the capital raising process concludes. So you need to understand, first of all, that the capital raising process can be for a maximum of 90 days from the day that the intermediary says we now are starting. It can run for 90 days. The intermediary can be assisting prior to that, and in most cases they are for 1 to 2 months, to create some market interest. They like the company is having an established website so that people can find out more information about this entity. And they will be encouraging the company to make sure that their suppliers, their customers, their team members, the community in which the business operates have been informed of what the company is doing without saying, we want you to invest in our company. They can do that once the official 90-day period or the period of the capital raising commences, and then publicise the capital raise. But prior to that, there can be some subtle promotion of the company via a website that the company is operating. And that's considered very important by the intermediary. But the company could have agreed at the very beginning that the capital raising is for a lesser period than 90 days. I don't subscribe to that theory. I'd always say, well, let's have it earlier. But if the sum of money to be raised has been nominated at $1 million, and even though it's a 90-day capital raise, when the $1 million is raised, the intermediary could then call time, even if that's only after 10 days, the capital sum has been raised. The directors, they can set an initial capital raise and then have a supplementary amount that they can roll onto if they've raised the first amount of money within the 90-day period. But if the company wants to roll on and then have a second bite at the cherry, if we can put it that way, they have to have already submitted to the intermediary what they will do with that extra money. So if their initial raise was targeted at $1 million and they then had a supplementary raise prepared of, say, $300,000, they have to submit information which the intermediary can then disclose on the website to say, this is what we're going to do with this extra $300,000. The retail investors get special protection. They have cooling off periods of 7 days, so they can, in fact, change their minds and ask for their money back. No questions asked. We've changed our mind. We want our money back. We're a retail investor. We didn't really understand how all this worked. So the directors need to be aware that that could happen, and the intermediary is legally bound to immediately refund that money to that applicant and destroy their share application. So the company directors should never know that Mr. X applied for a number of shares and then received a refund. There is an investment limit for retail investors in a company of $10,000, and that is all the shares that can be payments that can be made by an individual investor, and the intermediary has to monitor that. And again, the directors need to be aware of it. At the end of the capital raising process, the intermediary prepares a detailed summary to go to the company saying, these are all your new shareholders. You've now got to allocate the shares to them. And this is the amount of money we've received. Unfortunately, though, if the total amount of money has not been raised, so if the target was $1 million and it was a 90-day capital raise, at the end of that, only $933,000 has been raised. $933,000 has to get repaid by the intermediary to those various investors, and their share application forms destroyed. So the company never sees their names and the money goes back. The intermediary does not get paid because their payment comes out of the final income received from the sale of the shares in the company, and that hasn't been completed properly if the capital target has not been raised. So this means that when companies are setting their capital targets, they have to be fairly conscious of the fact that if they make it too high, they may waste a lot of time and effort and money in this whole process. The intermediary won't be very happy either because they've done a lot of work for no reward. So the intermediary could well be challenging a company first up capital raise of saying, I'm going to raise $5 million. They'll be asking a lot of questions and wanting to look at what data the company has got to support that, and may well be arguing against a $500,000 capital raise because they know the problem. If the company can only get to $330,000, $330,000 goes back. Everyone's done a lot of work, including the intermediary, and no one gets any benefit. If the targeted amount has been raised, as I said, a list of the shareholders then goes to the company. The company secretary then has to produce the share certificates, etc. The money received, let's say it's the $1 million, and let's say the fee has been set at 7.5% of the capital raised. That's what's been negotiated and contracted. So $75,000 would be deducted, and $925,000 would be deposited by the intermediary into the company's nominated bank account. And the list of new shareholders has been sent, as I said, to the company. Now it's the end of the process then. The intermediary sends their report to ASIC to say, we've completed this capital raise. That's the end of the contractual agreement between the intermediary and the company. The company can decide they want to raise more money, even in the same 12-month period if they wish. They're not bound to have to go back to that intermediary. They might have had a few arguments along the way and said, no, we're going to get a new intermediary. They're free to do that. Or they can go back and start new negotiations with the same intermediary. That's up to them. Obviously, they've got to have a new story to tell. Why do they need more money now? What are they going to do with it? What's it going to do to the overall value of this company? I've already said what I've had on there, so I got ahead of my slides. But that's explaining the process, and we'll move on. So this is the important question. What opportunities are there for accountants out of this whole process? I think there's a lot. This whole process just doesn't happen. Just think back what we've described. You've got one of your clients that's doing a few things, but do they currently have a business plan? Do they have a set of budgets and cash flow forecasts? Are they set up in their financial accounting systems to be able to get regular financial accounts? There's normally a lot of changes. So this process doesn't just happen, I don't believe, unless there's some involvement, preferably from accountants. Directors need an understanding of how this process works. That's the first conversation I have when someone rings me and says, will you give us a help on crowdsourced funding? Now, these days, those people are not my clients. I don't run a traditional accounting firm anymore. I run a consulting firm. So I'm being asked to consult on helping someone to raise crowdsourced funding. Invariably, an accountant's referred them to me. I prefer that the accountants were not referring to me, that they were then using the ESS BizTools material to be able to deliver this system yourself. But I come into various arrangements with accountants as to how we can support them. So directors need to understand how all this works. I think to qualify with the intermediaries, and this is very important, the intermediaries do not just accept everyone who contacts them to go into crowdsourced funding. That was not the intention of the legislation, and it definitely was not how they operate. So I think it goes back to saying we need to make sure these companies are set up as efficiently as we can and that they look like a listed public company. Now, I was the chief financial officer and company secretary of a listed public company some years ago, and there are set processes, including audits. Incidentally, you don't need an audit in a crowdsourced funding company unless $3 million in total has been raised. I disagree with that. I think if you're raising money from the public, you should always appoint an auditor, but that's up to the individual companies. Now, let's get back to what we've got on the screen now. There needs to be a rhythm of meetings so that the company's got some style about it, and the directors can see that it has. So daily, weekly, monthly meetings of the leadership team. There'll be meetings of the other teams in the organisation as well, but I'm concentrating now on talking about directors and the leadership team. All companies need a business plan. And for a company that aspires to raise capital, it's more important. It's very important that the leadership team and the directors have been involved in the preparation of this business plan and that it clearly sets out the objectives. This is what we're going to achieve. This is how we're going to do it. This is what it's going to cost. This is the team we need. All this information. And there's definitely got to be buy-in to this by the directors and the leadership team members. It is their document. Even though I'm suggesting that you coordinate the whole process, it should be done with a series of workshop meetings so that you meet with the directors and the leadership team members and utilise material. If you subscribe to ESS BizTools, we've got extensive checklists of all sorts of subjects to do with a business plan, so that you can be guiding the company through and then writing the business plan and then taking it back to them and having them all sign off on it. I think this ownership of a business plan is vital. It's one of the big missing ingredients in hundreds of business plans that I've been asked to look at over the last 35 years. I've rarely seen a sign-off. Now and again, you'll see the chairman or the owners sign. I think everyone in the directors and the leadership team should be signing off. And that's what the intermediary is looking for. What's the commitment in all this from these key people who are getting their funding lined up for the next 12 months at least, because they know the company's raised $1 million, they probably should get paid. They also need to have some entity in this game, and that is that they've signed off on the business plan. Directors need to know that accurate projections have been prepared. So this is the financial forecast then, which are the interpretation of the business plan. Budgets, key drivers, that's those key sub-accounts, debtors, creditors, capital expenditure, repairs and maintenance, research and development, I meant to say that, research and development. Repairs and maintenance might be a problem in some of the businesses also. And what's the cash flow forecast look like? And what's the projected balance sheets? Because they're important documents. And I mentioned directors there. So we started off in all this process of having directors who are probably just the family members or whoever's been involved in this business. But you need to bear in mind that a successful company will at some stage be introducing some new directors, and the intermediary will probably be very keen to see that occur before the capital raising process starts, because it gives some credibility if one of the directors, or maybe two of them, have got some real business experience that they're bringing, their knowledge, because the public's going to look at them and say, well, this is two or three people that have been running this business. They're good tradesmen, they're good professional operators or whatever they are, but they're now introduced two people who might have had public company experience or rather large private company experience. They're getting that benefit of that knowledge and that skill that can impress investors. The projected balance sheet's a very important document because it's saying to, first of all, the directors and the leadership team members, this is what we expect this company to be looking like in 3 years' time. And that's what you're then saying to the public when you put that document onto the website as part of the capital raising process. There also needs to be a lot of attention given to making sure that sufficient data is going to be flowing through the organisation to keep the leadership team informed. This is from a director's point of view. They'll be looking for this. Key performance indicators or other business metrics. So a functioning board of directors is very important. And in my opinion, functioning board of directors means monthly board meetings. And monthly board meetings are a chaos unless there is proper reports being submitted to them. Who's going to prepare all this information? I think it's going to be you. Because these companies that we're talking about, even the ones that can raise $5 million, I don't think they're going to be very keen about employing a full-time chief financial officer. Costs a fair bit of money. You get an experienced person to do that these days. So there's a golden opportunity for your firm to be offering services as a virtual CFO to ensure that the information flow is there, not only for the leadership team, but very importantly, to ensure that every month the directors are getting all of the financial data that they require. And a key component of that is the long-term cash flow forecast, at least 12 months out, being updated every month, so that there's some real consideration being given. And the cash flow forecast for 12 months is not something that's prepared in 5 minutes. It's looked at, it's analysed, and any potential problems should be highlighted so that the board's kept informed. Now, we've got to do all that, and we've probably got to do everything I've described there in some format to enable enough information to be available to prepare the crowdsource funding offer document. Now, this is the equivalent of the prospectus, I suppose, nowhere near as detailed, but an important document if your client wants to raise their $1 or $2 or $3 or even $5 million target. So this work presents tremendous opportunity for accountancy firms who are committed to delivering financial, commercial, management, accounting advisory services to SME companies. This is what this is all about. Companies need assistance, and I'm going to show you why they need assistance very soon. So what do the figures say? Let's have a look at what's happened in that 7-year intervening period. Crowdsource funding equity raising, I don't think, has reached its potential in Australia. The results have been disappointing. An average of less than 70 companies per annum have actually participated. Note, I didn't say have tried to get involved. These are the ones that actually participated in an environment where many businesses are having difficulty in raising funds. It's been pretty hard out there to raise money. According to the Small Business Ombudsman, the failure rate of small businesses is at an all-time high. Now, I'm not suggesting every one of those companies that unfortunately have failed over the last few years could have raised capital as a crowdsource funding equity raising, but I think some of them probably could have. They may have had to beef up their board of directors, maybe to have some capital injected beforehand. But were they even aware that that process was available to them? Equitise, which unfortunately is not currently operating as an intermediary, but we're one of the real stars originally 7 years ago, published a report about 2 years ago stating that they turned away about 95%. Just think of these figures, please. 95% of the companies that had discussed with them utilisation of crowdsourced funding equity raising. And I've read articles where the then chief executive of another intermediary had similar figures. Birchall, sorry, I got a mental break there. Birchall had said that they have something similar. They turn away about 95%. So why? The Equitise report summarised why they did that. Not properly prepared. The company directors had no idea. They just thought they were going to fill in a form and get it $5 million. They didn't understand the process. And that's why I've been emphasising it's important that the directors and leadership team members understand the process. They had never faced up to preparing the offer document into a document that the intermediary was going to accept. Their business planning and budgetary processes were not satisfactory. The things didn't line up. The business plan didn't line up with the budgets and cash flow forecasts or the other way around. In other words, documents have been prepared by two different groups and they didn't match up. And the directors or leadership team did not understand the whole concept of crowdsourced funding, which is basically, this is a public company raising, a little bit different, but there are rules and obligations. And at the end of it, there potentially is a pot of money. I think this presents a tremendous opportunity for accountancy firms to specialise in assisting small companies with turnovers up to 25 million. Someone took me up on that one day when I said that. He said, oh, they're pretty big small businesses. Well, they are, but in the scheme of things in Australian public companies, they're not. They're small, but up to 25 million could start this, what we call the innovation journey. This can be great. Now, at some stage, some of these companies may elect to make an initial public offer to list on a stock exchange, but that's well down. At this stage, they're here. Now, I don't suppose too many of the people that are interested in what ESS Bistools produces are really contemplating helping someone to become a listed public company, and if so, preparing an initial public offer for their clients. I don't think that's really the work task for the accounting firms that I'm talking to, which are all over Australia, but are looking at servicing the SME market. But most definitely, these companies are in the market for the accounting firms that we are communicating to. Most definitely, companies up to turnovers of $25 million. Some of these companies that have successfully raised capital at present have virtually no turnover, very low. It's all in the future. The leading crowdsourced funding intermediary is Birchall, based in Melbourne. They've currently got about a 70% share of the market. They're a great organisation. That's a great result for Birchall, but I think these figures are showing what could be achieved in Australia if there was a concerted approach. And I'm now turning to you as accountants. I think the concerted approach has got to come from accountancy firms in communicating with your clients and prospects in your area, in becoming familiar with the crowdsourced funding equity raising process, and then promoting the concept to some of your clients and some of your prospects. Because I think you should have the opportunity to help crowdsourced funding equity raising investment ready processes within your firm. And let me share with you what I think the challenge is. This is the challenge to supply these services. ASIC originally thought they needed 16 intermediaries. That's what they appointed originally back in 2018. The annual admission rate over that 7-year period has been 70 companies, of which virtual secured an average of 49, 70%. If these figures were extrapolated over the 16 intermediaries for a full 12-month period, this would mean a total of 784 companies, which would be an increase of 714 on what's currently occurring per annum. I think there's potential fee generation for accountants here, which should not be left on the table, because other people will try to create this opportunity if we don't. I've sat down and done an analysis of what I believe the fees. Now, I might be overstating the results a little bit, but I don't think so. I think there's at least $50,000 in fees for an accounting firm who supply the service to get someone from the very beginning to having raised their capital. And let's just go through it. First of all, to give advice on crowdsourced funding to a board of directors and leadership team takes me at least 3 hours. One took 5, but 3 hours. And I'm saying it's $300 an hour, $900. So I calculated these figures, and I've got my worksheet here. I didn't put it into the slides, so I'll just refresh my memory as I'm going through this. Businesses need this 52-week business enhancement system. I think it's important that you're able to say to the intermediary, we've introduced a system which will enable daily, weekly, monthly reports. Weeklies, the weekly performance report, and monthlies, obviously the financial accounts. So I've got $1,600 there. I've got 2 hours of a partner level at $300 and 5 hours at an intermediate type level, $1,000. That's $1,600. The rhythm of meetings is very important, but they just don't happen. In my experience dealing with people running SMEs, we need to be on their back. So I'm saying $700. It was 1 hour of my time, $300, and 2 hours of my intermediate at $200 an hour. The big job is the business plan. Business plans are vital, very important documents in the overall scheme of things. You might be able to do this a bit cheaper than $23,600, but that's up to you. To do a business plan for a business that's going to raise capital, and I'm very mindful that they're going to raise capital, I've budgeted that I would spend 60 hours on that and charge that at $300 an hour. I got 15 hours from my intermediate at $200, that's $3,000. And then my secretary assembling all this and getting it all together, far better than what I can. 20 hours at $130, that's $2,600. So that aggregates $23,600. Then we've got to turn to the budgets and cash flow forecasts, the projected balance sheets, and making sure everything ties up back to the business plan. 20 hours at my time, $6,000. 20 hours at my intermediates, at $200 an hour. So that's $10,000 in that fee. They need all this document. Then we go to the introductory meetings. Now, these are very important. I found the best way to deal with potential companies that are going into this is for me, or in your case, you, to make the contact with the intermediary. We supply you the details of who the intermediaries are, and I make contact with intermediaries once or twice a year, so I get to know who they are. We give you the details. Here's their phone number. Here's their email address. And we advise the intermediaries of any client that subscribes to this package so that they may give you, hopefully, a bit of priority if you make a call to them. But I'm saying 10 hours at $300 of my time communicating. Now, if your client wants you to travel and you're in Newcastle and you've got to go to Sydney or Melbourne to meet virtual, that's extra expense that have to be factored in there. But I've got $3,000 for that. The crowdsource funding offer documents, the prospectus for crowdsource funding, I'm saying that will cost $8,600. That was 20 hours of my time and 20 hours of my secretary's time to put all that together. And then we added that up and got $48,400, and I put a 10% contingency, so I've ended up with $53,240. Now, you could argue you can reduce some of that, and maybe some of that work's already been done. That's up to you to decide. But I'm trying to illustrate to you that this is a substantial amount of fee income. And we're not talking about any ongoing work yet. This is to get them into the game, to be able to raise $1 million, $3 million, $5 million. You may well then be able to become the virtual chief financial officer of the company for a fee. And I got one client being paid $125,000 a year to offer virtual CFO services for a client. So there's people out there getting that. Now, if we extrapolated those fees over 714 companies that I think the market can stand, that's $38 million in fee income for the Australian accounting industry. The ongoing benefit, I've jumped ahead of my slides here, is really then being involved as the supplying a virtual CFO service if you want to do it. And there's thankfully more and more accountants starting to embrace that concept. I think it's great work. And it's real work for your team members also to help them with challenging work. So this is a tremendous opportunity. ESS BizTools supplies you resources to cover every step of what I've just summarised to you. We've got detailed product packages. You can view them by going to our website, www.essbiztools.com.au. Click on and review the packages that are available. All of this that I've talked to you today is encompassed within our financial forecasting package, which is our top of the shelf package, as you'd expect, because we've got chief financial officers material in there. You can subscribe for this with a 12 months upfront subscription of $4,200, including GST. You get training, you get regular communications, you get a monthly newsletter we write that you can send to your clients to talk about the services that you can offer. So $4,200, I think if you start working out your return on investment on the income that I've just outlined, basically even if you halve that income, it's still a very good return. Admittedly, you've got to be looking for clients you've got to promote, and we will supply you with marketing material that you can use to promote that you're offering crowdsourced funding advisory services to your clients. Or you can pay it in 12 monthly installments of $455 if you wish. That will cost you a bit more, but both those figures include GST. I don't seem to have any questions. I hope that means I've answered everything. I'm a bit sorry we've gone a little bit longer than what I was really planning. If you would like to have a discussion with me on this, you can send me an email, peter@essbiztools.com.au, and we will set up a Zoom meeting where you can invite your colleagues in your firm or your whole team if you want to. I think my record is talking to nearly 100 people in one firm, but it's up to you. We'll set up a Zoom meeting and talk to you for about 40 minutes and give you an overview. But this is a great opportunity for accountancy. It's not an opportunity, I don't think, for every accounting firm in Australia. But I don't really know what the upper limit is of how many companies might be wanting to avail themselves of this opportunity. But I think we've got to be talking more positively about the benefits that businesses can get, small businesses can get, by having another group of investors in those companies. And this is how the whole free enterprise system started 500 or 600 years ago. It might have even been going before then. But we know from the Spanish and the Portuguese and the British, as they went round the world, a lot of those ships were, in fact, private companies. They had investors in them. This is the same thing where we can really help clients get on top. So thank you very much for being with us today. We will send you the recording of the webinar, and I hope that you have a great day, and I hope that I'm going to hear from you shortly. Please go to our website, www.essbiztools.com.au. Stay safe. Thank you very much.